Finance Core, Topic 8, Strategic Corporate Finance, Raising Capital, Stock Repurchases, Mergers and Acquisitions. Readings include Chapter 16, 19, and 21. So we'll start with the first learning objective, and that is understand early stage financing options, including venture capitalists, or VCs, and initial public offerings, IPOs. So early stage businesses struggle to get financing because they have no cash flows or negative cash flows. So in that case, it's going to be hard to get a bank to lend them money, or even, and if they do, to make interest payments. They also are not at the stage where they've issued any public equity, so they can't issue stock. So the private equity market, or PE market, fills this void. You can think of a couple different categories of the PE market. The first one is angel investors. Now, these are people that typically know the business owner, and they're often family members or friends, and they get in very early for a percentage of the ownership. At some stage, however, you need a lot more money, and this is where venture capitalists or VCs come in. Now, VCs are typically limited partnerships that pool money from endowments, pension funds, corporations, to finance these startups. And the VCs often play a very active role in overseeing and advising the business, since they've overseen a lot of new businesses. Also, VCs are not there for the long term. They're generally looking to get an ultimate exit strategy and take the business public within several years. So let's talk about early stage financing. Sometimes we like to give them names just so you have an idea of kind of what stage of financing they're asking for. So seed money is the first level. That's where you're just looking for a little bit of money to develop a product or a prototype or to prove a concept. And then a little bit later, you might get startup money, and that's where you're starting to really develop your marketing and product plan. And then you have first round financing. That's where you maybe begin, you need money to begin sales and manufacturing and distribution. You have second round financing, and this is a little bit more developed. You still need cash. You know, these small businesses, even if your EBITDA is positive, your CapEx is much larger as you're building fixed assets or acquiring fixed assets or building up inventory. Now, third round financing. This is a stage in which the company may be breaking even as far as cash flows at this point. It's contemplating an expansion, just getting bigger and bigger. Sometimes this is also called mezzanine financing. And then last is fourth round financing, sometimes called bridge financing. This is a company that's about to go public. If you watch the popular TV show Shark Tank, this is a way of thinking about how venture capitalists work. Now, if you watch the show, that show is really everything from seed money through probably second round financing. If you Google Shark Tank under the weather, you'll see an interesting story about this gentleman here trying to expand his business. He's already making money, but he's really looking for that expertise and also maybe looking to cash out a little bit. How he'd value the business. One way to do it, since this company is currently making money, is use some kind of multiple related to their cash flow. So if they're making $1 million a year, think of a multiple of 5 to 10 times that amount. Let's talk about initial public offerings. So initial public offerings are when a company, we say, goes public. What that means is the first time they're issuing public shares. They're transferring from a private firm that's closely held by the owner, maybe some early investors and the VCs, and then they're going public, where their shares will trade on, say, the New York Stock Exchange or the NASDAQ or even a regional exchange. The funds are often used for expansion, fund big acquisitions, CapEx, and also allow the founders and early investors to cash out. In other words, once their shares start to trade on an exchange, they can sell some of their shares to cash out of the investment. Now, investment banks, such as Goldman Sachs, aid in this pricing and marketing of the stock issue, and they're instrumental in this whole process of going public. How the shares are actually issued, there are several methods we can talk about. One is a firm issuance, where the investment bank purchases all the shares and then takes the risk to sell them. You have the best efforts method. That's where the IB just sells as many shares as it can at an agreed upon price. And then you could have Dutch auctions, where the IB auctions share at highest price. And that's what Google did and when they went public. So Google sold 19.6 million shares at a price of 85 in a Dutch auction IPO. However, at the end of the first day of trading on the exchange, the stock price was selling for $100. So those that bought it at 85 in just a few hours, they made $100, or their stock was worth $100, which is an 18% gain in one day. So if you think about from the perspective of the investor, that's great. However, from the perspective of Google, they missed out on $300 million of extra financing if they could have somehow figured out that $100 was the right price. Now, underpricing of IPO stocks is a very persistent fact that we see in research. From 1980 to 2015, there was a 17% average first day return of IPO stocks. And so researchers have really been trying to figure out, why should this exist? Why are these companies giving up on this money? So actually, here's an interesting study I found asking CEOs about IPOs and underpricing. So the first question they asked the CEOs is, why did you go public? Right? Why did you transition from a private firm to a public firm? And let's talk about the most common answers. Number one, to create public shares for use in future acquisitions. So that is interesting as future acquisitions. The idea is, I want to create stock, so it's going to be easier for me to raise capital for future acquisitions. Two, to establish a market price or value for the firm. So they're trying to figure out what is the true value of this business. Three is to enhance the reputation of the company. Once you're a public company, that comes with certain reputational enhancements. Also, just to broaden the ownership of the firm. Here's one. It's probably a little more popular than people say. Allows one or more principals to diversify personal holdings. So what they're saying is that maybe that CEO could sell off some of his shares and maybe buy that nice house he was thinking about. Next, minimize our cost of capital. So the idea is maybe borrowing money from the bank was getting too expensive. Next one, allow VCs to cash out. So these are the top answers. Why do we go public? One is to, again, create cash, create the flexibility, monetize the business, be able to cash out. Now, why underpricing? Why are we giving up so much? Why do we give those investors in the first day on average 17 to 18% returns? One is they say, well, an IPO is risky, so we just need to compensate them. Next one is to increase the post-issue trading volume of the stock. So you want the stock to be very liquid. So a lot of buyers and sellers. So there's not, when those principals try to cash out, they're not moving the market. So by creating kind of a buzz around the stock, from the first day performance, it could help out in that area. Maybe underwriters just trying to get the favor of institutional investors. So occasionally there are a few dogs in IPOs, so you're trying to convince investors to keep coming back. So these are some of the ideas of why we think, or why CEOs think there's underpricing. The last thing I wanted to do in this section is talk about the valuation of an IPO. And I'm going to use the Uber valuation from Damodaran. So this is a spreadsheet that Aswath Damodaran from NYU developed to try to figure out, why is Uber, as of this date, selling for $27 when it's currently losing about $3 billion a year. So if I look at the base year here, you can see that their annual revenues are about $12 billion. Their operating margin is negative 32%. And then you can see that the after-tax operating income is losing $2.9 billion. So how could I use the DCF, discounted cash flow model, to try to come up with a price? Well, here's Damodaran's attempt. So what Damodaran starts with is the overall market. He believes that the overall, rideshare market is $400 billion. In the base year, Uber owned 14% market share, 21% of the revenues as a percent of the gross. And then he gets down to operating revenues of that year were $12 billion. Again, losing 32% on that. And then the effects of taxes. So the question is, how could you ever use that information to forecast the future to come up with a positive DCF? Well, what Uber suggests, or what Damodaran does, is he grows the overall rideshare market up to it looks like $1 trillion 10 years from now. He has Uber's market share going from 15% to 30%, so he's definitely predicting that's going to be one of the winners, maybe them and Lyft. Operating margins currently losing 32%. Looks like all he's doing is actually increasing that or making that a little bit better each year. Looks like he's going from -32 to -25, and by the 5th year, he's actually predicting a 2% operating margin, and that's when operating profits turn positive. And then at the 10th year, he's kind of using maybe an industry, industry average or a U.S. stock average operating profit margin of 15%. So he's just going to say eventually they're going to figure out how to make 15% operating margin on their business. Holds the tax rate constant at 25%. And then the question is, okay, so he's going to use that information to get his after-tax EBIT. So the question is, what about working capital, depreciation, and CapEx? So his assumption is there's going to be a ratio or a relationship between sales growth and CapEx, right? You're going to need CapEx to increase sales. And he uses a ratio of sales over capital ratio of 4-to-1. And effectively what he does with that number is every year he looks at the sales growth, and if sales went up by $1 that year, he's going to assume that CapEx, it would need a CapEx of 25 cents. So that's the basic assumption, and he just has this title or this section called minus net reinvestment. So basically he just takes the change in sales each year times 25%, and assumes that that's the CapEx needed to generate the additional sales. And then he gets the free cash flows to the firm. You can see the free cash flows turn positive 6 years from now. He holds that 4-to-1 reinvestment to sales ratio constant. And then last step, at the end of the 10th year, he just puts a terminal value. And I looked into the spreadsheet, and all he did is he took that final year's free cash flow and used a growth perpetuity of equal to the 10-year treasury rate. So basically the long-term growth of the economy. So 10 years, he's just going to say it's going to grow at the same rate as the economy. And then he just needs a discount rate. All right, so we need a discount rate to take the present value. So what he does, he starts out at 9.47%. Now, since Uber is so hard to value and the capital structure is going to be changing so much, DeModern just looked at percentiles of cost of capital for US-based companies. And he just says, well, I'm going to start off the company at a kind of 75th percentile, so relatively high cost of capital. And he just kind of takes it up to the 10 years from now, that terminal year, and basically just uses the 50th percentile. So that must be his estimation of the average firm's cost of capital, 774. And then he just takes the present value of all free cash flows to the firm, comes up with 50 billion. He then does something interesting. He said, well, there's a 5% chance this whole operation fails for whatever reason, legislative or legal or whatever. So he just takes that value and reduces it by 5%. He looks at cash on hand, adds that. Here's a section on cross holdings. It looks like Uber holds investments in other stocks, so he kind of considers that as cash. And then gets the value of the assets. He takes out the debt, it's really net debt since he's adding cash and taking out debt here, divides by number of shares outstanding, and comes up with a $35 stock price, and the stock is selling for 26. So DeModern's saying it's either fairly priced or maybe a little underpriced. But you can see the number of assumptions needed to value a company like Uber and why the stock varies so much, because there's so many assumptions. If you just download the spreadsheet, if you go to this link down here, you can just start playing with the operating profit margin in year 10, or that 4-to-1 capital to sales ratio, or the discount rate, and you can see that you can easily get valuations between $10 or negative, and maybe even up to $100, just making some relatively small changes to these factors. So I just wanted to give you an idea of how you value one of these startups. It's really hard, unless you do something like use some kind of EBITDA multiple. So one way to do it would be to just kind of get to their EBITDA. Out here, let's just pretend that this operating income is their EBITDA, 10 billion, and say that on average US firms have an EBITDA multiple of 20. So multiply 20 times 10 billion and take the present value of that. That would be an easier way to come up with a valuation. I'm not sure if it's better or worse, but it would be easier. So in this topic, we talked about early stage financing options, which includes VCs and IPOs, and we talked about maybe doing a DCF on a really early business that's losing money today.